The Asian Development Bank expects rising geopolitical risks from the conflict in the Middle East to slow growth for developing Asian economies this year. In its latest report, the ADB expects regional growth to come in at 5.1% this year from 5.4% in 2025. And it also warns that further escalation in the Middle East conflict could further weigh on growth next year. The ADB also sees inflation hitting 3.6% this year amid rising energy prices due to oil supply disruptions. That's higher than the 3% price growth last year and also more than double their 1.6% estimate in December. Well, Asia's direct trade links with the Middle East has left it exposed to the closure of the Strait of Hormuz. Supply disruptions of oil, fertilizers, and key gases such as helium have raised production costs in the agricultural and manufacturing sectors. And the conflict also disrupts aviation links between Asia and Europe, which will weigh on tourism-dependent regional economies. And for more, we're joined by Albert Park. He's a chief economist at ADB. Albert, it's good to have you on again. Just to pick up from your report, which notes that the Iran war, envisaged to last around a month, would cause regional growth to moderate slightly to 5.1% in 2026. If this fragile ceasefire collapses due to the ongoing offensive in Lebanon, what is the ADB's growth scenario for the region then?
Right. The forecasts we announced today are based on an early stabilization scenario where the war lasts about a month. But of course, we're now in week 6 of the war. There's a ceasefire. It seems fragile. We did some scenario analysis looking if the war lasts another 3 months or another 6 months or another year, what would that mean for growth and inflation in the region? And of course, as you might expect, the more prolonged the conflict, the bigger the impacts negatively on growth and positively on inflation. If it lasts, let's say, 6 months, we would expect growth to be 0.7% percentage points lower than our current forecasts. And if it lasted a year, it would be 1.3 percentage points lower. So those are, of course, significant. It would vary quite a lot across economies. But not really the same level as, let's say, COVID or some of the other large earlier global shocks like the global financial crisis or the Asian financial crisis going back many years, because it's more of a supply side cost shock, not a global demand shock like those other events.
Right. Albert, oil prices, they have rebounded. We're looking at $98, $99 a barrel, and that's despite the truce. I mean, at what price point does the energy spike move from being manageable to actually hitting economic growth for especially your net importing countries? And I know you talked about that worst case scenario, the severe crisis scenario that could slash, 1.3 percentage points. How, I suppose, are we at least further away from this scenario?
Right. Our worst case scenario, a prolonged conflict, envisions that oil prices would get as high as $155 a barrel for the next quarter and then stay at something like $140 a barrel. One thing it's important to note is that, April, this month, if the war continues, we're really going to start seeing shortages. Earlier, there were a lot of ships already en route. So during the first month of the conflict, the region could still access the oil being delivered on boats arriving that had already passed the straits. But now we're in a period where we're going to see a much more obvious shortage for countries that have been unable to find alternative sources of oil and gas.
Right, Albert, there's also talk of a toll system for the Strait of Hormuz. I mean, how would such a tariff on a key global choke point like that affect the competitiveness of Asian exports to Europe and the U.S. as well?
Well, it could be meaningful because 80% of the oil and gas flowing through the Strait of Hormuz is destined for Asia and Pacific. Of course, it would depend on how such a tolling system were implemented. How much would it cost? We've heard that charge of $2 million per vessel. We know the largest tankers can carry 2 million barrels of oil. And if oil is priced at $100 a barrel, that's something like 1% of the cost. But for smaller ships, that percentage would be higher. I think as long as the oil flew freely and the toll system was implemented at modest levels, then it should not hamper economic activity as much in Asia. But the devil would be in the details, I think.
Yeah. In the meantime, we continue to talk about this a lot. Developing Asia, of course, massive net import of refined products. The higher prices also mean that we might see interest rates stay higher for longer. This is also coming against a stronger USD. What is the risk of sovereign defaults in Asia Pacific? I mean, which economies are the highest risk of a possible balance of payments crisis? Are you already starting to see perhaps early signs of stress, especially in more leveraged economies?
Yes, it's a big concern of ours. And ADB has established a facility to provide financial support to countries that are really struggling to deal with the challenges caused by the Middle East conflict through fast dispersing budgetary support and also more access to trade finance to import needed oil and gas, given that financial conditions may tighten. Of course, debt to GDP levels in the region have come down a bit since the height of the pandemic, but not down to levels of the pre-pandemic. So different countries are experiencing different abilities to mobilize fiscal resources. And some of them that have had chronic budget deficits, current account deficits, and external debt exposure, those are the economies that are most vulnerable if they're also relying on imported oil from the Middle East. So some economies like Maldives, Laos, Fiji are countries that we're keeping a close eye on.
Right. And Albert, if I may just squeeze one more question in. In response to this crisis, governments have been looking at energy subsidies. But you think that they should allow energy prices to, in fact, pass through to, first of all, encourage conservation instead? Because I think you said that, generalized subsidies, they actually risk distorting incentives and perhaps also misallocating resources. But with the cost of living crisis remaining a key issue in many economies, is this truly politically feasible, and how willing would governments be, wanting to ease up on the subsidies?
Right. Well, what we've observed is that many countries have implemented subsidies or reduced excise taxes on imports of oil and gas to provide some relief to domestic consumers and producers. But our advice has always been to try to target those subsidies as much as possible, especially given the uncertainty of how long this conflict may last. You can't really eat up your fiscal space too quickly by across-the-board price subsidies. And as you mentioned, if you are not sending the real scarcity price signal to consumers and producers, they won't respond as much. In terms of changing their behavior, reducing their consumption, economizing on the use of these inputs, which is an important part of adjusting to this higher cost environment. So our advice has always been to try to target as much as you can. Think about the poorest in particular, use social protection programs. Many poor do not drive automobiles. You could subsidize public transportation. Really think hard about where your vulnerable people are and prioritize them. If you have enough fiscal space, of course, you can be more generous. We're also worried about some small and medium enterprises, which could be viable in general, but maybe struggle in the short term to get through this period of a challenging external environment.
Albert, always good to talk to you. Albert Parkway, Chief Economist at the ADB.